Your creative hobby can suddenly cost you thousands of dollars. Etsy sellers often find themselves utterly baffled by tax time. This confusion stems from several key factors and a lack of clear guidance for many new entrepreneurs. One big hurdle is understanding gross income versus net profit. Many sellers celebrate making $10,000 in sales, but forget about the substantial expenses involved in earning that money. For example, the cost of materials alone can easily be $3,000 for $10,000 in sales. Then you have shipping costs. If you ship 1,000 packages throughout the year, that could be another $5,000 in postage fees right there. Packaging supplies, like boxes, bubble wrap, and tape, could add another $500 to your annual expenses. Etsy itself charges a variety of fees. There is a 20-cent listing fee for each item you put up. If you list 200 items annually, that is $40, then a transaction fee of 6.5% applies to the total sale amount, including shipping. For that $10,000 sales figure, this means $650 in transaction fees. Payment processing fees are another 3% plus 25 cents per transaction. So if you made 200 sales, averaging $50 each, your processing fees would be around $300 plus $50 for the individual transaction charges. These fees quickly accumulate. Many sellers are surprised to learn these costs when they prepare their taxes for the first time. They often assume the money in their bank account is pure profit, which it almost never is. Another major source of confusion comes from the dreaded Form 1099K. For years, this form was sent to sellers who had sales totaling $20,000 and at least 200 transactions. This federal threshold created a false sense of security for many. If you made $19,000 and 199 sales, you might not get a form, but you still owe taxes on all your income. The threshold changed for 2023 to $600, but this change was then postponed and revised again for 2024 and beyond, creating great uncertainty for millions of small business owners. This constant shifting of rules makes it incredibly difficult for an independent entrepreneur to keep up. Some states have even lower thresholds. For instance, Massachusetts has a threshold of $600 regardless of transaction count. Vermont also uses a $600 threshold. Illinois has a $1,000 threshold with 4 transactions. New Jersey also uses a $1,000 threshold. These state-specific rules are a nightmare for sellers operating nationwide, especially those selling to customers across all 50 states. Misunderstanding this can lead to serious compliance issues and unexpected audits. Understanding what counts as a deductible expense is another massive learning curve. Almost everything you spend to run your Etsy shop can be a legitimate business expense. This includes your craft supplies like fabric yarn, beads, or wood. Tools used for production, such as sewing machines, laser cutters, or kilns, are also deductible. Even the computer you use to manage your shop and the internet service you pay for can be partially deducted. If you work from a home office, you can claim a home office deduction. This can be done by calculating the percentage of your home used exclusively for business, or by using the simplified method of $5 per square foot up to 300 square feet for a maximum annual deduction of $1,500. Many sellers forget these valuable deductions, potentially paying hundreds or even thousands of dollars more in taxes than necessary. A business earning $30,000 in gross income with $15,000 in deductions only pays tax on $15,000 of profit. But without tracking those deductions, they might pay tax on the full $30,000. That is a lot of money to lose. Marketing expenses are also fully deductible. This includes Etsy ads, which many sellers use to boost visibility, often spending hundreds or even thousands of dollars annually. It also covers money spent on social media advertising on platforms like Facebook or Instagram. Even fees paid for professional photography to make your products look good are business expenses. Website hosting for a separate shop or a blog that supports your Etsy business is also deductible. Small business owners often miss these things. They just focus on the sales numbers and forget about all the money going out. Record keeping is paramount, but many creative types find it tedious and postpone it. This leads to a mad scramble at tax time, trying to piece together a year of financial data from 100 or more different transactions, sometimes even 500 or 1,000 transactions. Many sellers are also unaware of self-employment tax. When you work for an employer, they withhold Social Security and Medicare taxes from your paycheck. As an independent contractor or small business owner, you are responsible for paying both the employer and employee portions of these taxes. This amounts to 15.3% of your net earnings from self-employment. 12.4% goes to Social Security, up to an annual income limit of $168,600 for 2024. The remaining 2.9% goes to Medicare with no income limit. This tax can be a huge surprise for sellers whose only prior tax experience was as an employee. A net profit of $20,000 means a self-employment tax bill of around $3,060. This is on top of your regular income tax obligations. It is a significant chunk of money that can really hit your savings. Estimated taxes are another area of massive confusion and potential penalties. The Internal Revenue Service expects you to pay taxes throughout the year if you anticipate owing at least $1,000. Quarterly estimated tax payments are due on April 15th, June 15th, September 15th, and January 15th of the following year. If you do not pay enough tax through these quarterly payments, you could face penalties that add hundreds of dollars to your tax bill. The penalty rate can be over 6% of the underpayment for a given quarter. Many first-time sellers are unaware. They get hit with a huge bill and a penalty for underpayment. This is a common and costly mistake. This also applies to state estimated taxes, which have their own due dates and forms, often with different thresholds. Sales tax collection and remittance adds another layer of complexity that can feel overwhelming. If you have a physical presence or nexus in a state, you might be required to collect and remit sales tax. However, for most Etsy sellers, marketplace facilitator laws simplify things greatly. Etsy generally collects and remits sales tax on behalf of sellers in many states where these laws apply, but it is not always automatic for every situation or every state. Sellers need to understand their state-specific obligations. Some states might still require registration, even if Etsy handles collection. Researching each state where sales occur is impractical for a small seller, but failing to do so can lead to legal issues. A seller in New York selling to a customer in California might be impacted by California's complex rules, including its 7.25% state sales tax rate plus local district taxes, which can push the total to over 10%. Inventory management is another often overlooked aspect with critical tax implications. The cost of goods sold, or COGS, is crucial for businesses selling products. This includes the cost of materials used to create the item, as well as direct labor if applicable. Properly valuing your inventory at the beginning and end of the year directly impacts your COGS and thus your taxable profit. Many small hobbyists turned business owners do not track inventory this way. They might just expense everything as they buy it without considering what is still on the shelf. This can lead to inaccuracies in their tax filings and miscalculation of profit by thousands of dollars. Understanding when to expense materials versus including them in COGS is a nuanced point. For example, a roll of vinyl costing $50 might be used for 20 different products sold throughout the year. If you expense the whole roll, but only use half of it, you are overstating your expenses by $25 and understating your profit. This adds up with many items. Even things like business mileage can be a significant deduction. If you drive to purchase supplies, attend craft fairs, or meet with suppliers, you can deduct the mileage. For 2024, the standard mileage rate is 67 cents per mile. Driving 200 miles to a major craft fair could mean a deduction of $134. These small deductions add up quickly. Many sellers just use their personal vehicle for everything and never track these trips. They are leaving money on the table for the Internal Revenue Service. Going to the post office 10 times a month could easily be 100 miles in a year worth $67 in deductions. Trips to art supply stores or fabric shops also count. 150 miles a month for 12 months is 1,800 miles, which at 67 cents per mile equals $1,206 in deductions. Professional development also counts as a deductible expense. Taking an online course on marketing your Etsy shop or attending a workshop to learn a new crafting technique is a deductible expense. Even subscriptions to business-related software like accounting platforms or design programs are valid deductions. A $100 annual subscription to a bookkeeping service or a $500 course on photography can reduce your taxable income. These are legitimate business expenses designed to help your shop grow and improve. A $300 website template or a $40 monthly subscription for email marketing software also adds up. Membership fees for craft guilds or trade organizations are also deductible, sometimes costing $100 annually. The sheer volume of information needed to correctly file taxes as an Etsy seller is overwhelming. It is not just about filling out a Schedule C. It involves meticulous record keeping, understanding income streams, categorizing expenses, navigating state-specific tax laws, and keeping up with federal changes. A new seller starting in January might feel completely lost by April. Many rely on basic spreadsheets or even just bank statements, which are insufficient. Dedicated accounting software like QuickBooks, Self-Employed, or Wave Accounting can make a huge difference. These tools integrate with bank accounts and categorize transactions automatically, saving hundreds of hours and reducing errors, which could cost thousands of dollars in penalties. They can easily track hundreds or even thousands of transactions annually. The complexity of differentiating between a hobby and a business also causes headaches. The Internal Revenue Service has 9 factors to determine if an activity is a hobby or a business. If it is deemed a hobby, expenses can only be deducted up to the amount of income generated and cannot create a loss. If it is, a business losses can often be deducted against other income. Factors include whether you carry on the activity in a business-like manner, your expertise, the time and effort you spend, and whether you expect to make a profit. Most Etsy sellers intend to make a profit, so they are generally considered businesses, but the distinction can still be blurry for very new or small operations. For example, if you sell just 5 handmade cards for $50 total and consistently lose money on supplies, the Internal Revenue Service might view it as a hobby. But if you are actively marketing, reinvesting profits, and spending significant time on your shop, even if you have a slow year with only $1,000 in sales, it is likely a business. This impacts how you file your taxes and what deductions you can claim. The intention to make a profit is a key indicator. Many sellers also get confused about when to register their business as a formal entity, like an LLC. Most start as sole proprietors, which is the simplest structure. This means your business assets and liabilities are not separate from your personal ones. Forming an LLC can offer liability protection, but also adds administrative complexity and sometimes additional state fees. An LLC might cost $100 to $500 to set up, depending on the state, and may require annual reporting fees of $50 to $300. These extra steps can deter many small sellers. There are also annual registered agent fees, typically between $100 and $200. Understanding the difference between capital expenditures and ordinary expenses is another challenging aspect. A capital expenditure is a purchase that provides a benefit for more than 1 year, like a new kiln or a fancy camera. These are typically depreciated over several years, rather than expensed fully in 1 year. An ordinary expense is something consumed within the year, like craft supplies or marketing costs. Getting this wrong can lead to incorrect deductions and potential issues if audited. For instance, a $5,000 laser cutter might be depreciated over 5 years, meaning you deduct $1,000 each year. But a $500 batch of yarn for products would be fully expensed in the year it is sold or used. The wrong classification can impact your current year's tax liability by thousands of dollars. The Internal Revenue Service provides specific guidelines for asset lives, sometimes up to 7 years for certain equipment. Even seemingly simple things like shipping income cause confusion. Sellers often think of shipping costs paid by the customer as a direct pass-through. However, the Internal Revenue Service views all shipping income as gross revenue. Then the actual cost of shipping is deducted as an expense. So if a customer pays $10 for shipping and it costs you $9, you report $10 of income and $9 of expense. Some sellers only report the $1 difference, leading to understated income by hundreds of dollars over a year. Every single penny received from a sale, including shipping and gift wrapping fees, is considered income. This is a common oversight that can trigger audits for tax evasion. The importance of having a separate bank account for your business cannot be overstated. Mixing personal and business finances makes tracking income and expenses almost impossible. It also makes an audit much more difficult. Having a dedicated business checking account simplifies bookkeeping immensely. You can easily see all business-related transactions in one place. Many new sellers start by using their personal account because it seems easier, but they quickly regret it when tax time rolls around and they have to sort through hundreds of mixed transactions. This simple step can save hundreds of hours of frustration and thousands of dollars in potential errors. Most banks offer business accounts with low or no monthly fees if certain balance requirements are met. Finally, many Etsy sellers delay getting professional tax help until it is too late. They try to navigate the complex tax landscape themselves, leading to errors, missed deductions, and potential penalties. A qualified tax professional specializing in small businesses or e-commerce can provide invaluable guidance. The fees for a tax professional are also a deductible business expense. Investing a few $100s in professional advice can save thousands in incorrect payments or penalties. It is a smart business decision, often overlooked by those trying to save every penny. The learning curve for small business taxes is incredibly steep and often unforgiving. There are so many moving parts, from income tracking to expense categorization to understanding various tax forms and thresholds. It is a full-time job in itself just to stay compliant. The creative joy of selling on Etsy can quickly turn into a financial headache if these tax obligations are not properly managed from day one. Many small business owners underestimate the sheer volume of record keeping required. They might sell hundreds of unique items each year. Each item has its own material, costs its own labor if applicable, and its own shipping and packaging. Tracking all this manually is a colossal task. It is easy to lose track of $20 here or $30 there, but over a year, those small amounts add up to hundreds or even thousands of dollars in either missed deductions or unreported income. The Internal Revenue Service does not make exceptions for creative businesses. They expect compliance just like any other business. The lack of readily available, simple to understand resources tailored specifically for Etsy sellers contributes significantly to this widespread confusion. Many official tax documents use highly technical language, making them impenetrable for the average person. So yes, your passion project can become a significant financial responsibility very quickly, and the consequences of not managing it properly can be severe. This includes penalties for underpayment, late filing, and even interest charges on unpaid taxes. It is a reality that many small online sellers have to face.